Okay, good morning. I hope you had a good spring break. We are going to be starting chapter 9 today. We have 5 weeks left. We have 5 chapters left to cover, and it's not as much as it sounds because in one chapter, for example, we only have 3 learning objectives. The last chapter has 6, but they go really fast because they're all interrelated. So we're getting the heavy lifting's done. This week, chapter 9 is a little bit longer than some of the chapters we'll see coming up. The final exam is over chapters 9 through 13, so it's all the material starting today through the end of the term. So the final exam is not comprehensive. Starting out with the question, you have this question. We're talking about, in this chapter, liabilities, and so to position ourselves to remind ourselves what a liability is. Which of the following accounts below is usually not a liability? So you have 4 to choose from. You should have selected your answer. Let me see what we have right now. Okay, about 75% of you have this correct. So I'm going to go through the answer. I'm not closing it yet. It won't close for a few minutes, so you have the opportunity to change your answer. Okay. So the answer here is investment in bonds. When we look at liabilities, we're looking at things like accounts payable, interest payable, taxes payable. Unearned revenue is a liability. Unearned revenue, it represents money we've gotten from customers for services we haven't delivered, that we haven't performed yet, or for merchandise we haven't delivered yet. So the first 3 on this question are all definitely liabilities. Investment in bonds is an asset. We would have talked about that in an earlier chapter. So what we've done is, so far this semester, we started at the top of the assets, worked our way down the balance sheet to all the assets. We've covered investments, plant, property, equipment, inventory, cash, accounts receivable. So now we find ourselves in liabilities. Okay, now your exam, it seems like forever ago, but we had an exam the week before spring break. If you'd like to go over your exam, you can go see Haley Tuesday this week, 10:30 to 12:30, 10:30 a.m. to 12:30 p.m. tomorrow, or Wednesday, 11 a.m. to 1 p.m. She's in room 579 in the College of Business. I will be sending this out in an email this afternoon to everyone. So if you don't have it written down, know that you'll be getting an email about this from me, about seeing her to see your exam if you'd like to do that. Okay. What's due this week? Normal week. We have Chapter 9 homework due this Saturday, and it'll take you some time, but it won't be a huge homework. I don't think it's too bad. Okay, so with that, we're going to start liabilities. Okay, and we're going to cover Learning Objective 1, which is accounting for current and contingent liabilities. And I'm going to talk about Target right now, about their financial statements. You don't need to memorize anything about Target I say today. I'm using it as an example. Also want to put a plug in. We have a lot of writing today, and keep in mind the PowerPoints are available on Blackboard. That can save you some writing, or if you don't want to download them ahead of time, know that you can, everything that I have up here on the screen today, other than the Target stuff, is in those PowerPoints available on Blackboard. So just in case you don't get everything quite written down, know that you can download the slides and they're there for you. So just keep that in mind as a resource. Okay, so Target. What I want to do, there's a specific reason I'm going to use Target today, but we're just going to do this. Target has a balance sheet, and they call their balance sheet Consolidated Statement of Financial Position. I know it's too small to see, and you don't need to see it. I'm going to blow up the parts we're going to use. But the first part of their Statement of Financial Position, which is their balance sheet, would be the assets. And then down about midway down, we see the liabilities, and that's the area is what I have circled there. So then if we expand that liability section, we see liabilities and shareholders investment. That's what Target calls its liabilities and stockholders equity. They call it liabilities and shareholder investment. So I'm zeroing in on just the liabilities that are listed on Target's 10K. So what I'm going to do now is I'm going to get rid of the numbers so I can make it even larger so it's legible. Okay, so liabilities and shareholders investment section. The very first thing on it is accounts payable. It's above the thing that I have circled. Accounts payable is probably the most common liability, and it's what Target owes its vendor. So it goes to buy inventory from someone, says I'll pay you in 30 days. That goes into accounts payable. Next item down is accrued and other liabilities. So all I'm doing on this 10K here is giving you an example of things we see in a real life balance sheet related to liabilities, because that's what this chapter is about. So accrued and other current liabilities, what's that about? Well, we would look in the notes to the statement, and if you looked in the notes to the statement, you would have a note, in this case, note 16, tells us that accrued and other current liabilities include wages and benefits, real estate sales and other taxes payable, gift card liability. Target sells gift cards. You can buy gift cards at Target, and when you buy a gift card from Target, Target immediately has a liability. It's an unearned revenue account, but Target calls it gift card liability. So you see that in that line, then you see dividends payable and things like that. So anytime you're looking at a financial statement for a company, know that the numbers are there, but if you dig in the pages following the financial statements, there's all kinds of good notes in there. And then the next two things I have circled are related to each other. The first thing says current portion of long-term debt, and the second thing I've circled is long-term debt and other borrowing. So Target has bonds, for example, that it's gone out and issued. It also has probably has some bank holdings where it's loaned money from the bank. And so what it does is it takes those long-term borrowings and splits out the amount that's due, the principal that is due in the next 12 months, and puts it in this category called current portion of long-term debt. Almost every company will have this section called current portion of long-term debt. It's the principal that they're going to have to pay over the next 12 months. The reason companies split it out is when analysts look at financial statements, the balance sheet, one thing they're looking at is they want to see if this company can meet its obligations in the next 12 months. It wants to say how's its financial health, can it make its payments on its debts. And so analysts will look at the current assets, which are things that they have available to them, resources within 12 months, and it looks at current liabilities, which are things that are due within 12 months, and hopefully you have more resources than what's due in 12 months. So that's why there's this split. So the current portion of long-term debt and long-term debt actually refer to the same loans. We just split it out to what principal is due versus what's due after a year. And in the notes, it'll tell you exactly when they have, what due dates they have on different debt. Okay, and then we have deferred income taxes and other current liabilities. Deferred income taxes are when Target owes income tax due to a timing difference. They won't pay it for 5 years or whatever down the road. It's a long-term difference, so they put that in deferred income tax as a liability that's not due right now. And that's perfectly legal, and it's not going to make any sense, but know that it's there. And if you're an accounting major, you get to study that in a lot of depth later on. And then other non-current liabilities, if we look in the notes, it'll tell us what that is. We see some deferred compensation, which is to executives. They'll get deferred compensation down the line, workers' compensation, income tax, pension benefits. So there's a lot of things in that other category. So with Target, so this is all of Target's liabilities that it's listing. That's what we're going to look at in this chapter. It's all those categories, at least being familiar with what are each of the different types of liabilities and where do they come from. Now, there's two kinds of liabilities. Today we're talking about current and contingent liabilities. So I'm going to talk briefly about contingent liabilities, then we're going to talk about current liabilities and end up back at contingent liabilities. Okay, a contingent liability, you do need to know the definition of it. A contingent liability is a potential liability that depends on future outcome of past events. So this is an if. There's a big if here. So we have a past event, and if something happens, we have a liability. This is like, you could think of contingent liabilities. A good example of a contingent liability is a lawsuit. So you're being sued over a past event, and you will have a liability if you're found liable, okay? So a lawsuit is an example of a contingent liability. Okay, now, what we do with a contingent liability depends on the attorneys, what they tell us in terms of the outcome of that, if this is a lawsuit. If the loss is probable, and we can estimate the amount, then this would be, we would accrue it, meaning we would put a liability on our financial statements. Okay. If the attorneys tell us, oh yeah, the loss is reasonably possible, but not probable, so reasonably possible. These terms, the language is quite important. If the loss is reasonably possible, so it's reasonably possible we could lose this lawsuit, then we discuss it in the notes to the financial statement. And then a third scenario, which is not listed on this slide, is if the loss isn't probable, if the loss isn't reasonably possible, so basically if the chance of loss is remote, we're not going to talk about it at all. So if someone files a frivolous lawsuit against us, we don't have to disclose it. Okay, so if it's a remote chance, we don't have to disclose it. And we're going to go through an example. Target had a data breach in fall 2013 that was pretty massive. So in a little bit here, we're going to talk about that data breach and the different contingent liabilities coming out of that data breach. Okay, now current liabilities are obligations due within 1 year generally. Okay, so now we're stepping back to the current liabilities bucket. So these are things that we're going to owe within 1 year. Okay, there are two kinds of current liabilities. There's ones that have known amounts and there's ones that have estimated amounts. Okay, so we have these current liabilities. We're going to start with the known amount. Okay, so current liabilities of known amounts. Again, these are just examples. If you need to go back, you can look at the slides that are, all these slides are available. Current liabilities of known amounts. So these are going to be things like accounts payable, short-term notes payable, sales tax payable, accrued liabilities. These are all things that we know the dollar amount. Payroll liabilities, unearned revenue, current portion of long-term debt. What we're going to be doing is we're going to be talking about some of these coming up here. Accounts payable, we're not going to talk directly about because we've used it a lot in prior chapters. Accounts payable, we buy something on credit, we're going to debit whatever we bought and credit accounts payable. That's how accounts payable comes about. We're going to talk about short-term notes payable. We'll talk about sales tax payable to some extent. So we'll talk about these. But these are current liabilities, known amounts, and so known amounts means we know the amount of it with precision. There's no guessing involved. There's no estimating. Here's the amount we owe it. So we're going to start with short-term notes payable. Short-term notes payable is due within a year. So this is something that we've contracted with, monies we owe. We usually use a short-term note payable to borrow cash or to buy equipment or buy something. When I worked at Plastic Lumber, we would issue a short-term note payable to buy a forklift whenever we needed to buy a forklift, and then we would pay it, the money out later according to the terms of the note. And with a short-term note payable, the company has interest expense, so it has to accrue interest expense, and you have interest payable at the end of the year. So this is an accrual entry. And this part of this chapter is going to feel really familiar because part of it, the accruals, we did back in Chapter 3. So there is some overlap with prior chapters. We're going to go through an example of the short-term note payable. And there's 3 journal entries you need to know regarding the short-term note payable. Okay, so here's our example. So this happened January 1st. On January 1st, a company purchased inventory costing $8,000. So that was basically, we had the inventory costing $8,000, and then coming up, we're going to accrue interest expense, and then we're going to pay it off. So we have 3 journal entries. Incur the note, sign the note payable, accrue interest, and then pay off the note. Those are the 3 entries. So the first entry we start with is purchasing this inventory. So we purchased inventory costing $8,000 using a note. So what we're going to do is we got inventory in, so we're going to debit inventory for $8,000. So we will debit inventory for $8,000. We will credit interest, we will credit notes payable for $8,000. So in this entry, when we got the note, when we signed the note to pay for inventory, we're increasing assets for the inventory value, and we're increasing liabilities for the note that we signed. So that's entry 1. Okay. So it was purchasing inventory using a note. Now, this note is a 10% note payable. That means it pays 10% interest for a year. This is a 1-year note. We purchased it January 1st, so it's due January 1st, 2015, in a year. This company's year-end, this is part of the example, is September 30th. So here's continuing that same example. So the company's fiscal year ends September 30th. So September 30th, the company needs to accrue interest expense for the period of time when they took the note out. So they took the note out January 1st to September 30th. So they need to accrue interest. So this is an accrual entry like we would have done in Chapter 3. So what we're going to see is we're going to see interest expense being debited for $600. Where did I get the $600? Well, it was the $8,000 note times 10% interest times 9 divided by 12. 9 is the number of months the note has been outstanding. We signed the note January 1st. This is September 30th, so that's 9 months. 9 months out of 12. So 8,000 times 10% times 9 divided by 12 gives us $600 as interest expense. And then the other side of this entry, we're going to credit interest payable for $600. So we're accruing the interest. So we're debiting interest expense, crediting interest payable, and this is an accrual entry just like we did in prior chapters. Okay, so we've done two entries. We did the first entry where we signed the note, so we incurred we have the inventory, and then we have the liability. We've accrued interest, and now the third entry is it's time to pay off the note. Okay, so January 1st, 2015 rolls around, and we need to pay off the note. So when we pay off the note, we first of all know that we're going to debit notes payable for the $8,000. When we pay off the note, we don't owe the $8,000 anymore. So we're going to debit the note payable to get rid of that. When we pay off the note, we also don't owe the interest payable anymore, that accrued $600 that we just did. So we want to debit that to get rid of it. When we pay off the note, we also have interest expense on the note from October 1st to January 1st because we accrued the interest through September 30th, so now we need to recognize 3 more months of interest. So what we're going to do there is we're going to take the $8,000 times the 10% rate times 3 months out of 12. I got the 3 months because we accrued interest through September 30th, so we have October, November, and December of interest to accrue on this note. And then my final entry, so I've wiped out all the liabilities associated with this note, and I've recognized interest expense. My final entry is for the cash that I'm going to have to use to pay off this note. The cash that I'm going to pay off the note with is the principal plus the full year's interest. So it's going to be $8,000 plus 10% interest, or $8,800. So $8,000 plus the 10% interest gives me $8,800, and then I can further check to make sure I'm right is I would add my debits, the $8,000, $6,000, and $200. That gives me $8,800, so I'm right balanced here. My debits equal my credits. Okay, so short-term notes payable, we have those 3 journal entries. Then we move on to another one. Sales tax payable. Okay, if you go to the store and buy something, say you buy something for $1 and you have to pay $1.07 for it because they've added sales tax onto it, the store only recognizes $1 as revenue. That 7 cents is a liability. So when you hand them $1.70, you are handing them $1 of revenue and 7 cents of liability. So let's go through just a quick example here. Let's say that sales at Home Depot totaled $200,000 in cash on a particular day, and Home Depot had to charge 5% sales tax, so $10,000 sales tax. So Home Depot, how they record that is the cash they got was $210,000. So they got the cash plus they got the sales price plus the tax together, so $210,000. And then they're going to credit sales revenue for the sales price. So the actual price they're selling it for is the sales revenue. And then my third entry there is going to be sales tax payable, because that is a liability. Sales tax you collect is never revenue. And I'm going to pause for a minute while you write that down. So the big takeaway here is that when you collect sales tax, it's not revenue, it's a liability, and you have to remit it to the government agency that you're collecting it for. Okay, let me get that one. Okay, so we have a question. So sales does not include tax. So sales and revenue are synonymous. Yeah, I mean the account sales can be called sales revenue. Yes, sales will never include the sales tax. So we could call it sales revenue, we could call it sales, we could call it just revenue. They all mean the same thing. They never, ever, ever include sales tax. Sales tax is a liability. The minute it comes in, it's a liability. Okay. that one. Okay, next up. Okay, now we get accrued liabilities. So accrued liabilities are those that we know that we owe, but we just haven't paid them yet. Examples include salaries and wages payable. So this is when we have year ends on Wednesday and our payday isn't till Friday. We have incurred wages through Monday, Tuesday, Wednesday that we need to recognize even though we're not paying them until the next year. Another one, interest payable. We just did that with pay the note that we would owe the interest on it. Income tax payable. This is a biggie. So the end of the year comes, and we have revenue, we have expenses, we have net income. We know we're going to owe taxes on that net income, but we're not going to pay the taxes until they are due. And for a corporation, they might be due in March. But there is a time lag between the end of the year and when the taxes are due. So at the end of the year, we need to estimate the income taxes that we're going to owe, and then we recognize income tax expense in the same year in which we record the income. Okay, payroll liabilities. Payroll liabilities we might need to accrue for if, like I said, the end of the period comes and payroll's not due for another few days. And payroll, when we talk about payroll liabilities, we can have wages, salaries, commission, and bonus. All of those are included in employee compensation. The payroll taxes, though, are not part of, I don't know how I want to say it. Well, I'm going to go to the next slide in just a minute here. There's an Exhibit 9-1 in your textbook that talks about the payroll taxes. So let's say we pay an employee $1,000 and we have to withhold $100 from that employee's paycheck for federal income tax. So we'll show salaries expense of $1,000, and then on the credit we'll show a liability to the federal government for the withholding for $100, and then the cash of $900. That next check amount you get goes to cash or salaries payable if we aren't paying it right now. Okay. Okay, unearned revenues. This is a biggie. Unearned revenues can be called all different things, but they represent monies that we've collected that we have not delivered the goods or the service yet. So they can be called deferred revenues, revenues collected in advance. We saw Target calls it gift card liability, which is really clear what it is. But the business receives cash before earning revenue, and it results in a liability. So every time you buy a gift card, if you buy a gift card at Starbucks and you give them cash and they give you the gift card, they instantly have a liability. Okay, they've got your cash, that's what they're increasing. They're also increasing their liability at that same time. And that is unearned revenue to them. When you use your gift card to pay for something, that's when it turns into revenue for Starbucks. Okay, we're going to do an example of unearned revenue. We're going to use Southwest Airlines. Because airlines sell tickets in advance, so you have to buy your airline ticket in advance. And a lot of times when you buy that ticket, there'll be a period end for the airline, and you haven't yet flown, and that's still unearned revenue for that airline. Okay, so let's go through. December 15th, let's say Southwest Airlines collects $300 for a round-trip ticket from Dallas to LA. So this is December 15th. They sell this $300 ticket. And on December 28th, the customer flies to Los Angeles. Okay, so first thing we're going to do is on December 15th, when Southwest sells that ticket, it's getting cash, so it's going to debit cash because it's getting the $300, and then its credit, it's going to be unearned revenue. And Southwest actually calls it air traffic liability. Okay, so that's their unearned revenue account. So Southwest on December 15th, when the customer buys his $300 ticket, Southwest has an increase in cash and an increase in its liabilities. It has not earned any revenue yet because it has not flown the customer yet. So then on December 28th, the customer flies to Los Angeles. So December 28th, what we're going to see is we're going to get rid of the air traffic liability for half of the ticket costs because the ticket's a round trip. The customer has flown half of that ticket. So we're going to debit air traffic liability for the $150 and credit ticket revenue for the $150. And where to get the $150? That was the $300 divided by 2. It's a round trip ticket. So we said December 28th, the customer has flown one direction on it. So Southwest recognizes half of the revenue on that December 28th. So as of the end of the year, Southwest has $150 of revenue for that $300 ticket, and it has $150 of air traffic liability or unearned revenue for the other half of the ticket. So now let's say, so then December 28th comes and goes, and now the customer flies back to Dallas and uses the ticket on January 4th. So what we're going to see there is we're going to get rid of the rest of that unearned revenue, because now the ticket's completely used, and we're going to recognize ticket revenue for the other half. And then from a T-account standpoint, when we record the liability initially, it's going to be, that's the $300 credit when we first sell the ticket. And then when the December 28th flight is taken, the $150 is earned, so it comes out of the liability, and then January 4th, we take out the rest when it was used. So at the end, after January 4th, Southwest has zero liability, has zero unearned revenue because it's recognized at all. But you cannot recognize revenue till you actually deliver the goods or services. Okay, the question is what happens if the customer doesn't fly for whatever? Yeah, and that's happened to me before. I haven't used a plane ticket for whatever circumstance. So if the plane, if the customer doesn't fly on that flight, if it's a non-refundable ticket, Southwest can recognize the revenue. But if it's a refundable ticket, then it has to go through, it has to wait until the customer actually uses it. But so many of the flights you take now are non-refundable. So if you miss it for whatever reason, Southwest is able to recognize it. So going back to the ticket dates. So, and then interesting about gift cards, not all gift cards are used. So companies will have companies know like 80% of their gift cards are used, and they have a way for estimating each year how much gift card would have quote-unquote expired. Even though it doesn't expire, there's some that will never be redeemed. So they can recognize a portion of that in some cases. But we're not doing that here. Okay. Now, so our next liability, current portion of long-term debt. This is also can be called current maturity or current installment. The big takeaway on this slide is the current portion of long-term debt is the amount of principal payable within 1 year. So the current portion of long-term debt, I want to emphasize that word, we're talking about the principal, not the interest. And this is actually long-term debt, so it could be a 30-year mortgage that we're holding, for example, and this is the amount of principal that we owe within the next 12 months. So we reclassify it from long-term to current because we want our investors to know what we have coming up due in the next 12 months. Okay, so up to this point, we have dealt with current liabilities that we know the amount. We know. We can look at the contract, we can look at payroll, or whatever it is, we know what the amount is. Next up, we look at the current liabilities that we have to estimate. So there's a couple different kinds that we have to estimate. That we don't know the dollar amount, So we're going to have to make an estimate. I'm going to wait just a minute. Okay, so next category is these amounts that must be estimated, the current liabilities that have to be estimated. Estimated warranty payable. When a company sells a product, oftentimes it has a guarantee that comes with it, a warranty that comes with it. The company doesn't know for sure that you're going to bring it back or that it will fail, but it knows a certain percentage will need warranty service. So we have a liability called warranties payable that we have to estimate. Now, the warranty period, when we're talking about a short-term warranty, could be 30 days, it could be 60, it could be 90, up to a year. So that's for a short-term warranty. Of course, you can buy a car that has a 3-year warranty, 5-year warranty, and part of that's longer term. Again, we're looking at current liability, so we're talking about warranties that are less than a year. And the company must record warranty expense in the period in which you make the sale. So when you make the sale, you don't know you're going to have warranty expense. So what companies have to do is they have to estimate how much warranty expense they'll have based on their sales. And companies generally know this. They have records of what they've done in the past, and they may find that, say, 5% of their sales end up having warranty expense. So they can accrue for it. So they estimate what the warranty expense will be. It has to be in the period in which they made the sale because we want the warranty expense associated with the sales. Okay, and then we're back to contingent liabilities. Contingent liabilities, it's, again, this definition we started with, the potential liability depends on future outcome of past events. And there's 3 possible things you could do. You could accrue, you could disclose, or you could do neither. And what we're going to do on the next slide, I'm going to condense the talk about the contingent scenario again, and then we're going to go through Target's data breach to show what kind of contingent liabilities they ended up with. Okay, so following up on contingent liabilities, we basically have 3 scenarios that accrue, disclose. Okay, so contingent liabilities, the probability. So if the probability is probable that we're going to have a loss, that the event will occur, then we would accrue and we would disclose. We never just put the dollar amount down and then don't talk about it. If we have a contingent liability, we're going to be discussing it in the notes. So if the probability is probable, we accrue and disclose. And we talk about accrue. What that means is we're putting the dollar amount in our income statement. It's hitting our income statement. It's reducing our income right now. Okay, next probability. If it's reasonably possible, we disclose. If it's reasonably possible, that means we don't have to put it in the income statement. So we're not going to recognize an expense right now for it, but we're going to discuss it in the notes. And then if the probability of this event occurring, of us losing, if we're talking about a lawsuit, is remote, then we don't do anything. Okay, we don't have to disclose, we don't have to accrue. Because people file frivolous lawsuits, for example, all the time, and we don't have to disclose those. Looking at a company's notes, one of the most interesting sections is for the contingent liabilities because you see what they're up to. You see what kind of lawsuits have been filed against them. You see what they think of it, what their legal counsel thinks of it. And this is important information for investors and creditors. If you're making a decision to invest in a company, you certainly want to know what kind of lawsuits are pending against them or what contingent liabilities they have. If you're making a decision to loan them money, you also want to know, very much want to know these contingent liabilities. You don't want to hide them, and you can't. So what we're going to do now is we're going to look at Target's data breach. And none of this information, these are examples for you just so you can see how it works in real life. You don't need to memorize this, so we're just going to walk through it. Okay, so this data breach occurred in fall 2013. and it ended up in Target's annual report. So in fall 2013, hackers broke into their point-of-sale terminals and stole credit card numbers for up to 70 million customers. And so the hackers, this is in fall, so they have to issue, Target issues their financial statements as of December 31st. So their notes to their financial statements for 2013, their 10K, the SEC report, the Securities and Exchange Commission, the report that Target files, their annual report, talks about that data breach. And this is a really good example of different types of contingencies. So what I've got here is there's excerpt 1 from their 10K notes. It tells in fourth quarter 2013, we recorded $61 million of data breach related expenses and expected insurance proceeds of $44 million. So what they're saying there is they had data breach expenses of $61 million. Insurance paid them $44 million. So that was a net of $17 million. And then after tax, because they would have saved taxes on that expense, it comes to $11 million. So that was the net effect in 2013. And you think, well, that's not very much for Target. Well, yeah, but these were things that they actually incurred. So this is what they actually had out of pocket in December 13. So it tells us even for the cost to investigate, have credit monitoring service, increase staffing, and get legal services on board. Okay? So then we go on to read, continuing with this, the excerpts. The $61 million of fourth quarter also included, and this is where it's important, an accrual for the estimated probable loss. Okay, so right there, they're telling you it's a probable loss. If it's a probable loss, that becomes, we have to accrue for it, and they're telling you in that first sentence that this includes an accrual for the probable loss. So they're accruing there for the expected payment card network's claim. So what they're doing, the expected payment card network's claim, what that is, that's Visa and MasterCard coming after Target saying, hey, we just had to reissue 35 million or how many ever million each of them had Visa cards. I know I got a new Visa card as a result of the Target breach, and that's not cheap for Visa to reissue those cards. Visa has to provide the new card, the labor to prepare it all, and then the shipping costs, the mailing costs to get to the consumer, and then you have to verify your account when it comes, and they have to staff that. So they've got a lot of expenses. So believe me, Visa and MasterCard are going after Target. So Target knows that, and Target says, yeah, our bad, we know that's reasonably probable we're going to have to pay that. So they made an accrual. So that's one set of expenses in with that data breach. Now, halfway down it says currently we can only reasonably estimate a loss associated with the settlements of the network's expected claims. So this is where Target's talking about Visa and MasterCard suing them for fraudulent use of those numbers. If someone steals 70 million credit card numbers, they probably have an intent to commit some fraud with those numbers. So Target here is saying, yeah, it's reasonably possible we're going to have some of these losses, but we don't know the amount, we can't estimate it, so they're going to disclose it, and that's what they're doing. Okay, so the fraud losses, it's reasonably possible they're going to have fraud losses, but no one knows yet, and they can't really estimate the dollar amount, so they're going to disclose it. And then on another note, it says state and federal agencies, including the state attorneys general, the Federal Trade Commission, the SEC, are investigating events related to this. So Target has all the regulatory agents breathing down their neck saying, okay, what happened? And they're looking to penalize possibly Target for allowing this breach to occur. So Target says, we are cooperating in these investigations. We might be subject to fines and other obligations. And it says, while a loss is reasonably possible, we cannot reasonably estimate a range of losses. And then it says, we do not believe that a loss from these matters is probable. So they're saying, This is, we don't think this is probable. We think reasonably possible. We can't come up with a dollar amount. So they haven't recorded a loss contingency liability for the penalties coming from the SEC, the Federal Trade Commission. A whole bunch of states sued Target as so they're saying, hey, we have these lawsuits, be aware of it, but we can't estimate the dollar amount impact, which makes sense. Okay, so basically, this is exactly the same slide, just phrased differently. We would accrue if the loss is probable and we can estimate the amount. This is the official FASB guidance, Financial Accounting Standards Board. Disclose if it's reasonably possible. So disclose just means write about it in your notes, just like we saw they were saying it's reasonably possible that we could pay a penalty, but we don't know the amount. Or if it's unlikely to occur, there's no need to report or disclose. Okay, so let's go through some of these. Okay, now this first one. Regarding possible liabilities arising from Target's data breach, how is the liability to the credit card companies for expenses associated with the credit card reissuance and other operating expenses treated? So this is the expenses of reissuing credit cards. So Visa and MasterCard are coming after Target, and they're going to make Target pay the expense of reissuing the 70 million cards. On these, I didn't want you to memorize this. So what I'm going to be doing is I'm going to talk through the answer. So the answer for this one is it should be accrued. And why is that? Okay? So you're going to have about 5 seconds or so to answer this question. The answer is on the board. This is not a trick. So the reissuance of the credit card expenses that Target has to pay to Visa and MasterCard, they're accrued because it's probable and they can estimate the amount. Okay? Okay. Okay, we're going to do another one again. Okay, the reason that was accrue is the loss related to credit card reissuance is both probable and the amount is reasonably estimatable. Okay, next one. Okay, regarding possible liabilities, how is the liability to the credit card companies for the fraudulent losses from the stolen credit card? And again, I'm going to give you the answer on this one. That one's disclosed because we're asking about the fraud. We're saying what does Target do? Well, Target talks about it in their financial statements, but they have no way to estimate the fraud impact from 70 million credit card numbers. A lot of it depends on how well they lock down the numbers and people reject charges and things like that. But they know it's reasonably possible that they're going to have some losses. They just can't estimate them. And then finally, one more. Okay, and that was just the explanation I just said. Okay. Regarding possible liabilities arising from Target's data breach, how is the liability for fines or other obligations? So this is where we're saying, what about the possibility of fines from the SEC or the Federal Trade Commission or the individual states? Basically, if we were reading about it, it was disclosed. Okay, Target has no way to estimate the dollar amounts of those. It's reasonably possible they could have some liability there, so they talk about it, but there's no dollar amounts in the financial statements because they have no way to estimate what that might be. Okay, now we've got a couple other questions not related to Target, and these are ones I'm not going to give you the answer for. So we're going to close this one in 5 seconds or so. I'll walk over and see. Okay, so now on to the questions that you need to answer. This was a true-false. The current portion of a long-term debt refers to the amount of interest on a note payable that must be paid in the current year. Okay, read it carefully. A little bit ago, I talked about this. I put one word really big When I talked about this right now, about a third of you have it wrong. Okay, so when I talk about this, there is one word in this that is key. And the word in here, I would have talked about the current portion of long-term debt. So we're talking about long-term debt. How much of this long-term debt is due this year? It's accuracy-based, 50-50. Are you going to finish? You can finish. Okay. Okay, another 5 seconds. Do check your notes on this. Okay, it's one word. I guess I'll get even more specific. Check your notes, and the big key word here, right here, let me see how many answers we have. Okay, final answer in 5 seconds or so. So get your answer in. Okay, and that is false. It's the amount of principal due. So when we're talking about a liability, the current portion of long-term debt, we're talking about the principal that's due. Okay, a couple more here. The next one, true, false. All contingent liabilities should be reported on the financial statements, even those that are unlikely to occur. Okay, all contingent liabilities should be reported on the financial statements, even those that are unlikely to occur. Again, a key part of this to zero in on is that unlikely to occur. Okay, we're going to have about 5 seconds left on this one. I do want to urge you, about 25% of you have the wrong answer right now. And when we were talking about contingent liabilities, remember that we've got, if it's probable, we recognize the liability. If it's reasonably possible, we disclose it in the financial statements. But then if it's remote, if the possibility is remote, what do we do? And that's where we're getting to this in this question, that we're saying it's unlikely, it's remote. What do we do? Thank you. Okay, go ahead. Okay, and that is false, because we only recognize a liability that's reasonably possible or probable. But if it's remote, if it's unlikely to occur, you're not going to see that liability in the financial statements. Let's have another one here then. Okay, all the following are reported as current liabilities except what? And emphasis on the word current. As you read this, think about current. A, bonds payable, B, sales tax payable, C, accounts payable, or D, unearned revenues. You're looking for the one thing that is not a current liability. Okay, looking for the one thing that's not a current liability. On each of these, when you're talking about current liability, you're talking about something that's due within a year. Are you going to have to pay this within a year? Okay, 5 seconds left on this one to get your answer in. Okay, and this would be bonds payable. Okay, bonds payable is a long-term liability. So the other item, sales tax payable, you have to remit it within a month of collecting it typically. Accounts payable typically have a due date of like 30 days or so, but they're always the first current liability. And unearned revenues are a current liability. So there's that. Okay. So that brings us to the end of class today. I apologize. We're done for today. So on Wednesday, we'll pick up with some more liabilities, and I'll see you then.